Good day, investors. This is Manish Shah from UpperCrust Wealth PMS, covering December month economic and market outlook for India. After a fall in September, markets had a comeback in October. November has been a month of consolidation. Markets continue to be focused on India fundamentals, as it is the domestic money which is the key driver of the markets rather than the global happenings. Globally, the month of the November has had a good set of news. COVID restrictions were relaxed for a time in China. European gas prices were lower. Logistic costs seem to have come down as well. And inflation numbers were good, and it seems like a Fed may slow or halt. I think let's wait and see the policy response rather than assuming. In India, RBI today hiked the rates by 35 basis points, giving a muted signal of their stance. One question that we have been receiving is about the impact of global recession on Indian economy and Indian markets. Let me share few of my thoughts. Let's look at it this way. Indian exports are around 18 to 19% of the economy. 2 or 3% slowdown in the Western world, to my mind, the worst case kind of a situation, our major markets, the Western world, may result in an impact of 0.5 to 0.6% drag on the Indian economic growth. The impact on this count, hence, should be muted. However, there is a chance that Western world does not see a slowdown to this lower extent. Now, the other way we can evaluate the impact is through the lens of a trade deficit. This is where it gets difficult and more interesting. A slower world growth would result in the lower commodity prices on a yearly basis. Most commodities are now showing the fall in prices. Oil, after the crack of now below are around $90 level. Oil dropping another $10, $10 fall in the price of oil would be, you can say, USD 12 to 13 billion dollars saved for our country. Now, here, on the other hand, if we get a strong global growth, if there is no recession, China comes back, China starts to grow, it will have a strong positive impact on the prices of the commodity, particularly oil. Given that today the supplies are very tight, and this may impact India negatively. To my mind, it may be best to track the level of the forex reserves of India, which happily have been increasing over the past few months, and forex reserves have acted as a time against the volatility in the external world. If the forex reserves are high enough to finance a current account deficit, as yet we believe that it is over 4 years that our current reserves can finance, we can sustain the business as usual conditions within the country. We believe we are comfortably placed on this count. Now, let's review the Q2 results. The season was stronger than expected on profits. Overall, for the universe of over 210 companies that we have, earnings declined 5% versus an estimate of 16%. While for Nifty earnings were 9% growth versus the expectation of close to 0% growth. So overall, much better on a 3-year basis, going back to pre-COVID levels now. The universe and the Nifty have seen 18 to 19% profit CAGR, which is pretty strong. Strong performance continued in BFSI, and lower than estimated losses in oil marketing companies drove the beat. As expected, metals and oil and gas reported sharp decline around 67% and 29%. Excluding these universe, Nifty posted a solid 30 to 33% earnings growth. A tad better than expected, driven by BFSI and autos. Among the other laggards, cement, healthcare figured out. Economy has now opened up and the costs have come back. Also, the higher cost inventory, which was carried forward from Q1, impacted the performance in Q2 as this was consumed in Q2, and impacted EBITDA margins, which fell by 5.4% overall to 12.8%. Going forward, as we move to Q3, we do expect margins to increase because now the inventory would have reflected significantly lower price levels. We noted that practically all industrial commodities bearing oil have declined sharply. For H1, the Nifty posted a growth of 15%. With a stronger performance by India Inc., the EPS estimate have been raised after Q2 results. For the FY23, it should be now close to 840 levels, and now for FY24, it should end the year between 950 and 1000. Hopes are now closer to 1000 again. Second, a significant part of the festival season this time around came in Q3, and that should also help the Q3 numbers on a YOY basis versus the last year. We do believe equity markets are positioned in a sustainable manner when looked at the valuations of India with respect to our own past 5 to 10 year kind of a period. We are equity focused house and our portfolios demonstrate our conviction. Investors should note that now our portfolios are mostly close to 20 stocks. We have brought up the meaningful weightages and now can be seen across the portfolio. They would see our portfolios getting more balanced on sizing. As we go forward, sector representation would also improve. Thank you.